Grip is a digital investment platform that uses tech-driven methods to provide a smooth investing experience to investors of all kinds. The platform started with leasing finance opportunities, but now provide other investment assets such as real estate, startup equity, and bonds. Grip's ideology is to keep an investor as its priority while curating risk-adjusted investment opportunities. With diversification at its core, these non-market-linked investment opportunities help in wealth creation for investors, regardless of their investment size. After a stringent due diligence process, Grip has also collaborated with over 70 corporate partners to create these investment opportunities. How does leasing work? Businesses need funds to function, and sometimes raising through equity or debt is not an option. So, if a company needs furniture or a machine for their office, factory, they can lease it. A lease can be an operating lease or a financing lease. Imagine, one of your friends wants to start a cab company, but he doesn't have any money to buy a car up front and no bank will lend him money. So 5 of you pool in 1 lakh rupees each and buy a car worth 5 lakh rupees and lease it out to him on the condition that at the end of every month, he will pay 20,000 rupees for the next 3 years. This is a win-win situation as you all make money and the monthly returns are predictable. He doesn't have to borrow and can repay from his monthly earnings. What if he can't repay? The 5 of you simply sell the car and divide the proceeds amongst yourselves. Companies raise funds through this route to keep their balance sheets asset light and their debt on balance sheet low. Is GripInvest safe? 1 year experience has been really good in terms of the performance. The IRR has been worth of 12% post-tax without any delay. My personal GripInvest 1 year review. Some of my observations based on investment experience. Assets. Equipment leasing deals with assets such as e-bikes, charging station, kitchen racks, water purifier, embroidery machines, home decor, ambulance. Tenor. Monthly payment with maturity of 21 to 36 months. Few deals have liquidity after lockdown period. Partner details. Fast-growing companies in B2B and B2C space. Most companies with recent round of funding. Deal frequency, structure, and size. The deal is structured as an LLP, which means that investor does not have to pay any tax on the cash flow. Almost every week new deals with minimum ticket between 20,000 Indian rupees to 50,000 Indian rupees. Sometimes combo deals with multiple assets are also available. Risk management. What is the most stable investment? Basically something which can provide consistent cash flow with limited risk. How does GripInvest manage risk? Comprehensive due diligence at the time of onboarding the partner, which involves getting comfort on the liquidity, promoter, industry analysis, credit profile, marquee investors, amongst other things. Security measures to protect against the risk like escrow mechanism, charge on revenue, upfront security deposit, PDCs, etc. Evaluation of the business performance of our partners on a monthly basis as we take monthly updates from them. Also, the portfolio exposure is into fast-growing industries and with known brands, strong client base, relatively low risk amongst several other factors. Details of my GripInvest portfolio. All my deals are performing as expected. Currently 0 delinquency delay. Some of the top deals invested by me and my friends were. How so? The opportunity involves leasing out storage racks, steel frames, and equipment to the company on lease. Charge Plus Zone. Funds procured under leasing transaction were used to deploy charging stations and power infrastructure for Ashok Leyland. Fab Alley, embroidery machine set for manufacturing of clothes. Furlenco. The investment was for leasing home decor and home appliances to Furlenco. How to invest in GripInvest. I follow the below points to analyze investment opportunity with GripInvest. Google information about the brand, like latest funding, promoters, growth prospects. Check the financials to see if it has adequate liquidity, good cash flows, and uptrend in growth. Prefer B2B deals and shorter tenor investment. If you are investing from an account with lower tax rate, you can choose to invest 2.5 lakh rupees and get pre-tax return directly. Now let's have a look at my portfolio.
So you just saw GripInvest review. Some of the things which you need to keep in mind while investing on any platform is to first see and understand if the deal makes sense to you. So Grip currently lists different kind of deals, one being corporate bonds, then it lists leasing deals, inventory finance, startup equity, and commercial real estate. So let's take each category one by one. So if you see corporate bonds, so you can see it has 5-star, you grow capital in a week. So two things what you need to keep in mind while investing in these deals. First, you need to understand what would be the post-tax return of these deals. If you're getting a deal which gives 10% return but taxed with 30%, then you only end up getting 7%. So first you need to understand that is this 7% worth the risk? And if you're investing from an account which has a low marginal tax rate, it makes more sense. Second, you need to compare the deals which are listed on Grip with deals which are listed on, say, a platform like Altify, and see wherever you're getting a better yield. The other kind of deals which you find on Grip are leasing deals. I think the leasing Grip was one of the first platforms to start leasing, and the performance has been really good. All the people who I know have invested on Grip leasing, and they've been doing it for 1.5 years. The performance has been good. There have been no defaults to my knowledge till now. This doesn't mean that things cannot change for worse in the future, but till now the platform is doing pretty well. So again, while investing in leasing deals, you should see the pre-tax returns and the post-tax returns also. So if, let's say, someone is investing from an account where the tax liability is low, it makes more sense to invest from a platform like Leaf, where you get pre-tax return in your account. Otherwise, if you're investing in an account which has the highest marginal tax rate, then you can just compare the deals with the Leaf deal. Otherwise, if you feel the yields are better here, if you feel that you're already paying 30% tax, it doesn't make much sense. If you invest through a pre-tax or a post-tax rate, then you can go for these deals, which are, because the deals on Grip, most of them you will get post-tax returns, which means that you don't have to pay tax after that, but the tax will already be deducted in this deal in the LLP itself. So let's say if someone doesn't have much tax obligation, doesn't make much sense to get post-tax returns. And then inventory deals are generally for low tenure, and post-tax returns would be around 8 to 9% for a tenure of 4 to 6 months. Again, if you're looking for short-term investment for parking money, it makes more sense. Otherwise, if you are looking only for a long-term investment, you can choose option whichever higher yield or a better tax efficiency. And then comes startup equity. Startup equity, I haven't tried many deals on startup equity, but it makes sense for those investors who have substantial capital and who, because startup equity, you need to invest at least 25 lakhs in a tenure of 5 years, and startup equity is generally risky. So basically you need to at least invest in 10 to 15 companies to ensure that you get a good return on your portfolio. So unless you have that kind of investment capacity and or outlook, I think a casual investor should avoid the startup deals. So yeah, that's how it is. So corporate bonds, you can check and audify also. You can compare the bond yields. There are similar bonds, see which bond is giving better returns for, and then for leasing deals compared to a Leaf. Sometimes the Giraffe also does some asset leasing, so you compare it with the platform, and then you can spread your deals also across platforms so that it reduces platform specific risk also. The platform might be doing well right now, but maybe there can be some change in the management in the future, and performance might not be good. So it's best to hedge your risk in whatever way you can.
You can read the full blog on this topic by using the link provided in the description. That's it for this video. If you enjoyed it, then hit the subscribe button and turn on the notification for future video updates. Also, share your reviews in the comments section. See you in the next video. Till then, bye bye.